If you ask any financial advisor what to do with your savings, they will give you the same boring answer. Just buy the S&P 500. Buy the haystack. Don't look for the needle. Set it and forget it. For 40 years, this was brilliant advice. It was the free lunch of capitalism. But the smart money knows a dangerous truth about markets. A strategy works until everyone does it. When 5% of the market is passive, it's a free ride. When 50% of the market is passive, it's a crowded trade. When 90% of the flows are passive, it's a suicide pact. We have reached the tipping point. The stock market is no longer a voting machine that weighs the value of companies. It has become a mindless flow machine. We are pumping billions of dollars every paycheck into a blind algorithm that buys stocks regardless of price, valuation, or reality. We have built the biggest bubble in history, not based on speculation, but based on automatic enrollment. To understand why this is broken, you have to understand how prices are set. Imagine a man walking a dog. The man is the active investor. He looks around, analyzes the path, and decides where to go. The dog is the passive investor. It just follows the man. For decades, the man active set the prices. The dog passive just enjoyed the walk. But today, the dog is 500 pounds and the man is 50 pounds. The dog is now dragging the man. Passive funds do not care if Apple is overvalued. They do not care if Tesla is earning money. They have a simple mandate. If you give me cash, I must buy these 500 stocks in this exact proportion, right now, at any price. This makes the market inelastic. It means that prices are no longer determined by the quality of the company, but by the quantity of the flows. If millennials get a paycheck, the S&P 500 goes up. It doesn't matter if the economy is crashing, the algorithm must buy. You want proof the machine is broken? Look at Tesla in December 2020. When Tesla was added to the S&P 500, it didn't change its business. It didn't sell more cars that day. But on the day of inclusion, passive funds were legally forced to buy $80 billion worth of Tesla stock. They had to buy it at the exact top. And to get the money to buy it, they had to sell the other 499 companies. Think about how insane that is. The algorithm sold cheap, profitable companies to buy the most expensive stock in history, simply because a committee said, put it in the list. This is buy high, sell low on an industrial scale. It transfers wealth from your 401k to the speculators who front-run the index. Every time a stock is added, you, the passive investor, are the sucker at the poker table paying the entrance fee. This mindless buying creates a specific type of bubble, the top-heavy bubble. Because the S&P 500 is market cap weighted, the biggest companies get the most money. For every dollar you put into the S&P 500, nearly 30 cents goes to just 7 companies: Microsoft, Apple, Nvidia, Amazon, Meta, Google, Tesla. This creates a feedback loop. People buy the index, the big 7 go up, they become a bigger part of the index buys more of them. It is a self-fulfilling prophecy. We don't have a diversified stock market anymore. We have a tech momentum hedge fund disguised as a safe index fund. The other 493 companies in the S&P 500, they are starved for capital. Their stocks are flat or down. Why? Because the blind algorithm doesn't care about them. The smart money calls this the bifurcation, and it leaves the entire economy resting on the shoulders of 7 CEOs. Now let's talk about the exit. ETFs promise you liquidity. They promise that you can sell your shares instantly at any time at the market price. This is a lie. An ETF is just a wrapper. It is a claim on the underlying stocks. If everyone tries to sell the ETF at the same time, the ETF manager must sell the underlying stocks. But who buys them? Remember, the active managers, the value investors, the hedge funds have been decimated. They don't have the capital to catch a falling knife. And the other passive funds? They are selling too. So you have a market with 100 sellers and 0 buyers. This is called a liquidity air pocket. In this scenario, prices don't drift down, they gap down. Apple could fall 20% in minutes. Not because Apple is a bad company, but because the mechanism of selling it is broken. You can check out anytime you like, but you can never leave. There is another hidden danger, the suppression of volatility. Passive flows act like a wet blanket. They dampen the daily moves of the market. This makes the market look calm. The VIX fear index stays low. This calmness convinces investors to take on more leverage. The market is safe, they say. But this isn't safety. It is a compressed spring. When the flows reverse, the wet blanket disappears. We saw this in Volmageddon in 2018. The VIX doubled in a single day. When liquidity vanishes, volatility explodes. We are currently sitting on the most compressed volatility spring in history. The smart money is buying tail risk protection, insurance against a crash, because they know that when this coil snaps, it will take the heads off the unwary. You might ask, if this is so dangerous, why doesn't the SEC stop it? Because the passive giants, BlackRock and Vanguard, are the most powerful entities on Earth. Together, they own roughly 20% of almost every major company in America. They are the largest shareholders of the banks. They are the largest shareholders of the media companies. They are the largest shareholders of the energy companies. They don't just own the market, they are the market. They have convinced Washington that index investing is democratizing finance. They market it as the safe, moral choice for the little guy. And to be fair, for 40 years it was. But trees do not grow to the sky, and mechanical systems do not run forever without maintenance. The smart money knows that when the regulators are asleep at the wheel, the crash is usually just around the corner. Finally, there is the rot inside the companies themselves. In the old days, if a CEO was lazy or incompetent, the shareholders would fire him. Active managers would stage a coup. Today, the biggest shareholders are Vanguard and BlackRock. They own 20% of the company, but they manage millions of companies. They don't have the time to police the board, so they just vote yes. They rubber stamp exorbitant CEO pay packages. They ignore bad strategy. This creates zombie companies, corporations that are poorly run but stay alive because their biggest investors are asleep at the wheel. Passive investing breaks the feedback loop of capitalism. It rewards size, not performance. It keeps the dinosaurs alive when they should have gone extinct. But here is the good news. If the market is broken, it creates opportunity for those who are awake. Because the blind dog ignores everything except the top 7 stocks, there are thousands of companies that are incredibly cheap. Small caps, value stocks, energy, industrials. These companies are trading at historic discounts because they aren't in the momentum basket. The smart money is executing a mean reversion trade. They are shorting the index, the bubble, and buying the unloved, the value. We are entering the golden age of the stock picker. When the index breaks, the baby will be thrown out with the bathwater. Good companies will crash with bad ones. That is when the forensic investor strikes. You want to be the one buying the dollar bills that the panic sellers are throwing away for 50 cents. Let's summarize the investigation. The S&P 500 is no longer a diversified safety net. It is a crowded momentum trade with a broken liquidity mechanism. The smart money playbook is a pivot to active management. 1. Reduce exposure to cap-weighted indexes. If you must index, look at equal-weighted funds, RSP, that strip out the mega-cap bias. 2. Look at small caps and mid-caps. This is where the value is hiding. They have been left for dead, which means the risk is lower. 3. Hold cash for the air pocket. When the liquidity crisis hits, you want to be the buyer of last resort. 4. Do your own homework. The era of set it and forget it is over. You have to look at the balance sheet again. The free ride is ending. The driver is waking up. Do not be the dog on the leash when the car goes over the cliff. This is the smart money wisdoms. The future belongs to the owners.